Welcome back to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today, we're diving into RTX Corporation, ticker RTX. Our mission today is a really rigorous examination of one of the true titans. Aerospace and defense landscape, we've got this complex conflict really at the core of the RTX investment thesis.
Hmm.
On one side, you've got just historic financial momentum, strategic scale, operational efficiency, stuff that should send the stocks soaring, right?
Right, the bull case.
Exactly. But then on the other side, there's this immediate multi-billion-dollar operational crisis. The GTF powder metal flaw, it's shaking the whole global commercial aviation world.
It really is.
So we're going to unpack exactly what those underlying structural strengths are. The things that allowed this company to absorb a financial hit of this magnitude while somehow simultaneously raising its core earnings guidance. It's quite something.
It is fascinating.
Yeah.
And, what justifies this deep dive, I think, is recognizing that RTX's ability to withstand such an immense operational stressor, it stems directly from its foundational structure.
Okay.
This isn't just, another big defense contractor.
Yeah.
It's been strategically engineered, really, designed for resilience.
Yeah.
So we absolutely have to start with the concept that's central to everything they do. Diversification.
Okay, let's unpack this core strategy first then, because like you said, it dictates their entire risk profile. So at the fundamental level, RTX operates on this.
It's a meticulously balanced hedge, isn't it?
It is.
A roughly 50-50 split between two massive, but often kind of anti-cyclical market sectors. Commercial, aerospace, and defense.
Exactly right. This dual market strategy is absolutely central. You have to understand it to get the long-term stability of this business. These sectors, they just operate on different economic clocks.
Right.
So historically, if you see periods where maybe geopolitical tension eases off or political shifts lead to defense budgets stagnating or even contracting.
Well, the commercial sector often counterbalances that. You get increased spending driven by, global economic growth, expansion of middle-class travel, airlines needing to modernize their fleets, and then conversely, during global economic downturns, which, let's face it, often hit commercial aviation hard.
Yeah, fewer passengers, deferred order.
Exactly. Lower passenger miles, airlines pushing back orders. Well, defense spending often stays pretty robust through that. It's sustained by long-term modernization needs, international commitments, and crucially, specific geopolitical flashpoints that require immediate hardware solutions now.
Right. You need the missiles now.
You do. So this diversification, it's really elegantly designed to mitigate that single sector risk beautifully. It provides a pretty robust earnings floor, kind of regardless of the specific economic or political climate.
And here's where it gets really compelling for an investor, I think. We're currently in this highly unusual and, frankly, highly lucrative moment.
Yeah, it's quite unique.
We're seeing this convergence where both cylinders are firing at the same time. You've got the post-pandemic commercial recovery creating just insatiable demand for new aircraft and, critically, for that aftermarket maintenance.
Oh, geez, demand there.
Right. And simultaneously, you have accelerated global defense spending, directly fueled by geopolitical events, the wars in Ukraine and Gaza, the renewed focus on strategic competition in Asia. It creates what analysts are, I think, rightly calling the perfect bull case for a company with this kind of balanced global exposure.
It's hard to argue with that framing right now.
But, of course, the strategy only works if the components, the actual businesses, are best in class. Which brings us to the three pillars of RTX.
Yes, exactly. These three major segments are what translate that strategic diversification into, physical production and actual revenue.
Right.
So first you have Collins Aerospace.
Okay.
Think of Collins as the really comprehensive systems and component supplier.
Yeah.
It's like the central nervous system and maybe the skeletal structure for modern aircraft.
Good analogy.
Their sheer breadth is just astonishing, really. Their scope covers an almost unlimited range of complex components. They supply systems from the cockpit, advanced flight controls, avionics, right through to the cabin, business class seats, lighting systems.
Wow.
All the way from the nose to the tail. We're talking essential stuff like landing gears, braking systems, advanced composite materials. And critically, Collins serves both commercial airliners and military transport and fighter platforms. So their products are deeply embedded across the entire aerospace value chain.
And what separates them, I guess, from a smaller supplier is that sheer scope of integration. They don't just supply a part, they supply the whole system that makes the plane work.
Precisely. That's a key point. Then next up is Pratt & Whitney.
Aeroengines?
The engine power supply, the heart of the machine, as you say. P&W competes directly on the global stage with the big players, GE Aerospace, Rolls-Royce.
Right.
On the defense side, they produce engines for absolutely critical, high-profile defense platforms. Most notably, the F-135 engine. That powers the global F-35 Lightning II jet. Huge program.
Massive.
Yeah.
And on the commercial side, their technology is really spearheaded by the geared turbofan, or GTF engine, that's been selected to power really popular narrow-body planes like the Airbus A220 and the highly prevalent A320neo family.
Okay.
And the sources we looked at highlight that the GTF family alone is responsible for powering a takeoff or landing somewhere in the world almost every single second.
Yeah.
Just demonstrates their immense global operational footprint.
Every second. That's incredible scale.
It really is. And finally, rounding out the trio, you have Raytheon.
The defense specialist.
Raytheon is the dedicated defense arm. They specialize in advanced integrated defense programs. Now, they're famous for missiles, obviously.
Patriot missiles, yeah.
Exactly. But their true value, I'd argue, lies in complex systems, like the globally critical Patriot missile defense system you mentioned, advanced anti-air defense platforms, sophisticated radars, space systems, and increasingly next-generation cyber warfare solutions. They are fundamentally a systems integrator and technology provider for governments that need cutting-edge kinetic and non-kinetic defense capabilities.
What's really compelling, though, and what makes RTX more than just, the sum of its parts, is that deep synergy you touched on earlier. It's not just two separate businesses stapled together. There's this constant beneficial flow of innovation and tech transfer.
Yes, that's crucial.
The sources we reviewed highlight this core advantage. Advancements perfected in one sector, say new heat-resistant propulsion tech or advanced materials science refined for a Raytheon defense program that often flows directly into the commercial side through Pratt & Whitney or Collins.
Right, enhancing the commercial offerings.
Exactly. It ensures the commercial offerings stay technologically superior, competitive. And meanwhile, the defense side benefits from the high-volume, cost-optimized manufacturing techniques they learn on the commercial production line.
It's a virtuous cycle, ideally.
Yeah. This shared technological leadership, combined with those historic macro tailwinds we discussed, that's exactly why we're seeing such profound strength in the financial results. Let's dig into those numbers.
Okay. Well, the primary indicator of this strength, and honestly the source of immense confidence for management, has to be the backlog.
Right. The future revenue.
Exactly. This figure isn't just future work. It provides concrete, long-term revenue visibility that really smooths out short-term market volatility. And RTX has reached just a monumental scale here. They reported a record total backlog of $251 billion as of Q3 2025.
$251 billion.
Billion, yeah. And just to put that in context for you, that figure was $236 billion previously and just $218 billion earlier in the year.
So it's accelerating.
It's accelerating rapidly. This aggressive accumulation represents a substantial 13% year-over-year growth in the total backlog. It tells us, pretty clearly, that demand is accelerating faster than production can currently keep up.
That visibility must be a powerful stabilizer for them. And looking at the segmentation, we see that balance reflected there too, right? It was, what, $148 billion commercial?
That's right. $148 billion commercial, reflecting that sustained recovery in air travel and aircraft manufacturing, and $103 billion allocated to defense.
Okay. So yeah, they're truly covered for years, pretty much irrespective of short-term economic bumps in either segment. But this backlog isn't just static, it's constantly growing, which brings us to the strength of their incoming orders.
Indeed. The true validation of their momentum isn't just the work they already have booked, but the rate at which they're acquiring new work.
And this is where we introduce that crucial metric, especially for heavy industry and defense contractors, the book-to-bill ratio.
Yeah.
This ratio tells you how much new contracted work the company is winning relative to the work it's actually completing and billing in a given period. And in this recent period, RTX delivered a massive 1.63x book-to-bill ratio.
Yeah, 1.63. That is an extremely strong signal in this industry. It means for every single dollar of completed work that went out the door, they secured $1.63 in new firm orders.
Wow.
The source material actually describes this ratio as one of the best ever encountered in the industry. It clearly indicates global demand for their products is drastically outpacing current production speed, which is, a fantastic problem to have as long as they can address the capacity constraints down the line.
Right. Good problem, but still a problem to manage. And the defense sector, in particular, was the engine behind that ratio. That reinforces the thesis of accelerating geopolitical demand.
It does.
We saw $25 billion in defense orders in the period. But the crucial geopolitical shift we really need to scrutinize is that 45% of those bookings came from non-U.S. buyers.
Yeah.
That just proves the accelerating international defense demand for key programs. And it signals maybe a strategic shift away from over-reliance on the, let's be honest, sometimes unpredictable U.S. budget cycle.
That point on international sales is absolutely critical. Look at the specific programs driving this. Major contract awards included $3 billion for Patriot and JAMT missile systems, mostly for international customers, $1.3 billion for the Standard Missile-3, SM-3,
right.
and importantly, $1.9 billion for the initial production order of LTAMDs. That's the Low-Tier Air and Missile Defense Sensor, a critical next-generation radar system. It's going to underpin the future phase of U.S. and allied air defense.
Foundational stuff.
Absolutely. Plus, Pratt & Whitney secured $1.3 billion just for upgrading the F-135 engine for the global F-35 fleet.
Yeah.
These aren't short-term orders, you know. These are multi-decade foundational programs.
Okay, so moving from orders to execution, let's look at the Q3 2025 financial snapshot. This is where the rubber meets the road, so to speak.
And the results here, they really demonstrate incredible underlying business health and the operating leverage they're achieving. RTX reported robust 13% organic sales growth in the quarter.
13% organic, that's strong.
Very strong. And this top-line performance directly drove a 19% increase in adjusted segment profit, up to $2.8 billion. And that was accompanied by a highly encouraging 70 basis point margin expansion.
Okay, that margin expansion is key.
It is. Adjusted earnings per share were equally strong, hitting $1.70. That represents 17% growth year over year.
Those margin expansion numbers really stand out. Often companies achieve growth maybe through acquisition or just pricing power, but margin expansion suggests deep internal efficiency gains.
Exactly.
But let's look at the balance sheet. This is a capital-intensive business. What does the cash flow picture look like? Because cash is king.
Well, the cash flow generation was outstanding in the quarter. It reflects excellent working capital management and, frankly, strong customer relationships. They generated a massive $4 billion in free cash flow, FCF, in the quarter alone.
$4 billion in one quarter. Wow.
Yeah. And that FCF surge was largely due to working capital improvements, but also, interestingly, advance payments received from customers. They specifically cited executing the Lot 18 contract at Pratt and major advances at the Raytheon defense business. This robust cash position gives them significant flexibility in their capital deployment strategy.
Speaking of deployment, in a capital-intensive, highly profitable business like this, shareholders are always looking at how that cash is returned, right? What do the sources say about their capital deployment strategy? Dividends, buybacks.
They maintain a pretty focused approach. That strong cash generation supports continued investment in R&D and capacity, which we'll definitely get to later, but also substantial capital returns. RTX is a consistent dividend payer, and they continue to prioritize buybacks. Their ability to generate such significant FCF while managing existing net debt levels, which, remain manageable given the sheer scale of that backlog, gives management a lot of confidence.
And that confidence is clearly reflected in the raised full-year outlook. That's the final piece of this financial momentum story, isn't it?
Yes, the management's confidence is palpable. They raised the full-year 2025 outlook for adjusted sales to between $86.5 billion and $87.0 billion.
Okay.
And furthermore, the adjusted EPS guidance was also raised significantly. They moved the range up to $6 and $10.26. So they're successfully executing growth and increasing profitability simultaneously. That's a rare feat in the current economic climate, frankly.
It really is. And it brings us neatly to the operational systems they rely on to achieve that. How are they doing it?
Well, the core driver behind that sustained margin expansion and profitable growth isn't just volume selling. It's a proprietary internal system they call CORE. It stands for Customer-Oriented Results and Excellence.
CORE.
This organizational methodology is directly credited with enabling 6 consecutive quarters of year-over-year adjusted segment margin expansion. That demonstrates repeatability. It shows this efficiency is really entrenched in the organization.
6 consecutive quarters is a tremendous achievement, especially, in an operating environment that's been historically plagued by supply chain volatility and inflation. But for the listener, we need to move beyond the acronym. How does CORE actually translate into results on the factory floor? How does it create efficiency where maybe others fail?
That's the key question. It creates organizational leverage and process optimization, fundamentally through data. The goal of CORE is pretty simple:
drive more output with minimal incremental resource input.
Do more with less, basically.
Essentially, yes. For example, the sources indicate that Collins achieved 11% organic growth with only a 2% increase in headcount.
Wow, okay. That's leverage.
That is organizational leverage in action. The POR system uses proprietary data analytics, often in real time, to optimize everything. Factory layout, machine maintenance schedules, and it's applied across their global network of 40 connected factories. And let's look at a concrete, tangible result they cited. At Collins, they implemented something called a smart torque system, driven by core analytics.
Smart torque, okay.
This system not only eliminated torque-related defects entirely, which is a critical quality control improvement, but by streamlining the process, it saved over 20,000 labor hours.
20,000 hours?
Yeah. That speaks directly to massive productivity improvements that lower the per unit cost and boost margins, all without compromising quality.
That leads directly into how they're securing their operational edge against all these global constraints we hear about. We know that raw materials, especially those highly specialized alloys, microelectronics, commodities, they've been persistent constraints across the entire aerospace and defense industry. How did RTX proactively address these supply chain issues rather than just, reacting to price spikes after the fact?
They adopted an extremely aggressive and highly coordinated strategy. They recognized that just having purchasing agreements wasn't enough. To counter the physical bottlenecks and quality control issues at their vendors, RTX deployed an army of experts. Specifically, 550 engineers were deployed directly to priority suppliers globally.
Wow, embedded engineers.
Embedded, yeah.
Yeah.
To assist with process flow, quality management, critical material management. This is about physical engagement on the ground to ensure they get the components they need when they need them.
And their procurement strategy sounds equally revolutionary, especially for a company that used to run as 3 separate silos before the merger. Tell us about the smart procurement strategy.
Yeah, this is a major efficiency win, really enabled by the unification of RTX. Instead of allowing each major business segment, Collins, Pratt, Raytheon, to go out and procure high-value strategic materials separately.
Competing against each other, potentially.
Potentially, yeah. Or just not leveraging scale. They combine the entire demand pool across all segments. This consolidated ordering approach gives RTX exponentially more negotiating power for essential, costly inputs, things like titanium, nickel superalloys.
Of really expensive stuff.
Exactly. And the result? They achieved cost reductions of up to 15% on key alloys used throughout their products. That efficiency is a long-term competitive advantage. It immediately flows to the bottom line and makes their final products more cost-effective compared to rivals.
Okay. Now, let's pivot slightly to the long-term profitability model, because for the Pratt & Whitney segment especially, commercial services dominance, what people often call aftermarket or MRO, maintenance, repair, and overhaul, that's the real moneymaker, isn't it? Why are these services so critical to the overall RTX financial picture?
They're absolutely critical because of the unique long-term economic model of engine manufacturing. The initial sale of an engine, the OEM or original equipment manufacturer sale, is often done at a very low margin, sometimes close to cost even, just to win the contract and get the engine on the wing.
Right, get the foot in the door.
Exactly. The real sustained profitability and the vast majority of the lifetime earnings from that engine comes from the mandatory aftermarket parts and services required over the engine's 30 to 40-year life cycle.
Wow, 30 to 40 years of service revenue?
It's a long tail. And commercial aftermarket sales saw strong 18% organic growth overall in the recent period, driving a significant portion of the segment's profitability.
And the commercial services profit growth was an outstanding 35% in the period. That's an exceptional figure. It really requires specific breakdown. What were the 3 primary structural drivers behind that kind of performance?
Okay, 3 key drivers.
Yeah.
First, there is significant pent-up demand.
Okay.
Despite the sharp rebound in air travel we've seen, the actual shop visits required for heavy maintenance, repair, and overhaul, they remain demonstrably below pre-2019 levels.
Still, even now.
Still.
Yeah.
This suggests that airlines are currently managing fleet utilization very aggressively, maybe pushing maintenance intervals where they can.
Yeah.
But there's a very strong, visible pipeline of mandated future maintenance work that must eventually be undertaken to keep those planes flying safely. That work is coming.
Right, it's delayed, not canceled.
Exactly. Second, we are seeing increased work scopes, meaning the sources indicate that as older engines cycle through the system for their second or maybe even third mandated shop visits, They're requiring heavier, more extensive maintenance procedures, more parts replaced, more complex repairs.
Ah, okay, so more revenue per visit.
Precisely. It materially increases the total revenue generated per visit, maximizing the profit realized every time an engine is cycled through an MRO facility.
Makes sense. And the third driver?
And third, there is external channel growth. This is really capacity-driven. RTX is continuously expanding its MRO capacity and improving its processes to meet this growing demand, both the pent-up demand and the increased work scopes. The sources specifically cite the efforts at Pratt & Whitney that increased output for PW1100 engines by 27%. That directly supports the overall growth in this highly profitable, high-margin services segment.
Okay, so we have established that the foundation of RTX is, well, rock solid seems fair. Record backlog, sophisticated efficiency systems like core, dominance, and high-margin services. But now we absolutely must test that foundation against the greatest operational stressor it has faced in years. The GTF powder metal crisis.
Yeah, this is the elephant in the room.
It really is. This is where the risk factor suddenly becomes the dominant conversation. What exactly is the flaw we're talking about here? Break it down for us.
Okay. This is a massive, highly specific near-term risk. The issue stems from a rare and frankly deeply unfortunate manufacturing flaw. It involves microscopic contaminants, tiny impurities, found in the powdered metal used to make specific critical components of the Pratt & Whitney PW100 GM-geared turbofan GTF engines.
Powdered metal. Okay.
Yeah. These are high-stress components we're talking about, primarily the high-pressure turbine discs and high-pressure compressor parts. The flaw creates a potential, albeit low probability, risk of cracking in the engine core under extreme operational conditions. And that potential risk necessitates immediate and accelerated inspections and, where necessary, engine removals.
And just to underscore the scale for our listener again, the PW1100G engines, they power the highly popular Airbus A320neo family. That's the workhorse of modern narrow-body fleets worldwide. This is absolutely not a niche problem.
Not at all. It affects hundreds, thousands of aircraft.
So when the issue was identified, how quickly did the operational impact escalate, particularly for the airlines relying on these engines day in, day out?
The operational shock has been monumental.
Yeah.
The required remediation involves a colossal effort of accelerated inspections and engine removals that will span years.
Yeah.
The operational impact is severe, particularly, as you say, for the airlines that operate these fleets, aircraft on ground or AOG levels.
Planes sitting idle.
It's exactly. Planes sitting idle for the GTF-powered A320neo fleet are expected to remain elevated through the entire year of 2026.
Through 2026. Wow. And when we say aircraft on ground, we're not just talking about some line item on an RTX balance sheet. We're talking about massive logistical chaos for the airline industry, delayed vacation flights, major airport headaches for thousands, maybe millions of travelers relying on the A320neo family every single day.
That's exactly right. The ripple effect is enormous, and the shock to industry capacity is worsened significantly by the repair timeline itself. Initially, Pratt & Whitney optimistically estimated that the repair work per engine would take around 60 days.
Okay, 2 months. Still bad, but manageable maybe?
Yeah, although that estimate has now ballooned. It's now expected to take up to 300 days.
300 days per engine.
Per engine. That is a 5-fold increase in the expected downtime for a single engine. This dramatic increase drastically worsens the industry-wide capacity squeeze that airlines are already facing, and it puts massive pressure on P&W's own MRO capacity. Overall, this requires inspections and removals for somewhere between 600 to 700 GTF engines over the next 3 years.
600 to 700 engines needing up to 300 days of work each. That's staggering. So we have this catastrophic operational constraint, but how does the financial cost, the cash strain, manifest against the backdrop of those record-breaking earnings and that massive $4 billion quarterly FCF we just highlighted? Where does the money go?
Right. The company did record a significant non-cash pre-tax operating profit charge related to this matter previously. But the near-term effect that shareholders are watching very closely is the actual cash drain required for customer compensation.
Paying the airlines back.
Essentially, yes. The 2025 free cash flow outlook explicitly includes a cash impact for payments and credits to compensate affected customers, the airlines facing grounding costs and lost revenue. And that totals somewhere between $1.1 billion and $1.3 billion.
Just in 2025, over $1 billion in cash outflow. That cannot be ignored.
No, it's a staggering cost. And this is where we have to try and maintain that balanced perspective you mentioned earlier. While it's a massive cash cost, this is the crucial context supporting the longer-term thesis for RTX.
Management has repeatedly framed this as a one-time temporary headwind that will largely be absorbed by 2026.
Okay, wait. Have to challenge that framing directly. The timeline went from 60 days to 300 days. That's a five-fold increase in operational risk, surely a significant loss of industry trust. Why should investors trust management's 2026 FCF baseline projection, that $8.0 billion to $8.5 billion number, the FCF excluding these powder metal compensation payments, when the cost and the complexity of this highly technical issue seem highly unpredictable and have already moved so dramatically against their previous forecasts?
And that skepticism is absolutely warranted. It's a fair challenge. But the projection, I think, relies on two key factors. First, their confidence in the operational fix itself and the MRO capacity expansion they are undertaking right now to handle the workload. They believe they have the engineering solution and are building the capacity to implement it.
Okay.
Second, and perhaps more importantly for the financial argument, is the sheer scale of the non-GTF business. The scale of the company overall, driven by that huge $251 billion backlog and the very healthy profits coming from Collins and Raytheon, that allows it to absorb a multi-billion-dollar crisis while still maintaining, and as we saw, even raising, its core adjusted earnings guidance.
So the rest of the business props it up.
In essence, yes. That $8.0 to $8.5 billion baseline FCF for 2026, excluding the charge, is basically a statement. It says the structural profitability of the rest of the business is so strong that it can compensate for the massive temporary cash requirements of the GTF fix. The GTF issue is undoubtedly a severe short-term problem, a huge one. But the underlying business strength suggests it's financially survivable, even if incredibly painful.
Okay, financially survivable. That leads us to think about the future trajectory then, beyond the crisis management.
Exactly. To understand that future trajectory, we need to look beyond the immediate crisis and examine where the capital is flowing, both in R&D and in strategic capacity investments. Because even while managing this massive GTF cleanup, RTX is aggressively future-proofing its defense and commercial operations to try and secure the next decade of growth. So on the defense side, for instance, Raytheon announced a substantial $300 million investment at its Redstone facility in Alabama.
Okay, what's that for?
This investment is specifically targeted to support the growing demand for programs requiring sophisticated manufacturing, particularly around high-growth areas like the Patriot missile modernization efforts, Coyote counter-drone systems, and other precision munitions, things that are in very high demand internationally right now.
Got it. Capacity for the hot defense items. And we're also seeing major next-generation R&D investments on the commercial propulsion side too, right? Despite the GTF issues?
Absolutely. The sources point to Pratt & Whitney's continued involvement in the CFM RISE program. Now, RISE, Revolutionary Innovation for Sustainable Engines, is a joint venture with GE Aerospace, focused on developing the next generation of engine technology, potentially including an open fan architecture.
The big open rotors we're starting to see pictures of.
Exactly. Targeting up to 20% fuel efficiency improvement. This is a huge long-term strategic bet, obviously driven by climate change pressures and persistently high fuel costs for airlines.
And the component level is still advancing too. It's not just big engine programs.
No, the innovation continues down the chain. Pratt & Whitney Canada, for example, was selected for the EU's Clean Aviation Program. That signals investment in next-generation sustainable propulsion technologies for smaller aircraft, too. And furthermore, Collins Aerospace is nearing certification of a new, lighter, and more efficient braking system specifically for the long-range Airbus A321XLR variant.
Okay.
So this aggressive R&D spending, happening even amidst the GTF crisis, confirms that the long-term strategic vision, betting on efficiency, betting on next-generation platforms, remains fully intact.
Absolutely. These structural investments definitely reinforce their strong position long-term, but we must circle back as responsible analysts and acknowledge the persistent structural risks and headwinds that will always accompany a business of this scale, especially ones so reliant on government contracts and global trade dynamics.
That's right. You can't ignore the inherent risks.
Policy shift remains a major, frankly unavoidable threat, doesn't it? That defense dependence exposes RTX to significant risks like budget uncertainty. We've already seen the instability associated with the recurring U.S. government shutdown risks, for example.
Always a cloud on the horizon.
Always. Furthermore, there is that ongoing executive order requiring a Department of Defense review of major defense acquisition programs, looking for potential cancellation if they fall, 15% behind schedule or over budget?
Correct. That review process is ongoing.
Now, while the company maintains this won't materially impact their current major programs, it is a constant high-stakes backdrop of risk they operate against.
Absolutely. And then there are the persistent operational constraints we touched on earlier. While they've deployed those 550 engineers, supply chain issues haven't been magically eliminated. They continue to cite difficulty procuring critical, high-value components, particularly specialized microelectronics and rocket motors. That directly affects Raytheon's delivery schedules on key programs.
It's still an issue.
It's still an issue. And we can't forget the measurable impact of the trade landscape either. Tariffs remain a real measurable headwind impacting segment margins. The sources note that Collins and Pratt combined saw approximately $90 million in year-over-year tariff headwind just in Q3 2025 alone.
$90 million just from tariffs in one quarter.
Yeah. That cost directly reduces segment margins,
Yeah.
and it's a structural constraint tied to international relations and policy that, frankly, they cannot control.
Okay, so if we synthesize all of this, the unprecedented scale, the operational excellence driven by core, the massive $251 billion backlog, and then this catastrophic multi-billion-dollar operational flaw with the GTF engines, what is the final verdict on RTX? We see a company trading at a premium valuation, often above 25 times earnings, certainly compared to its pure-play defense peers. Is that premium justified given this level of complexity and, frankly, this level of immediate risk?
That's the multi-billion-dollar question, isn't it? The premium is justified only if you take the long view, and if you accept the managerial narrative that the GTF issue, however painful, is fundamentally a temporary blip in a much longer story. RTX's core thesis, I think, is defined by that powerful dichotomy we started with. On one side, you have the proven operational excellence, the massive scale, the sustained margin expansion through the core operating system, the non-cyclical dominance of that aftermarket service segment, which provides steady, reliable cash flow. That's the bedrock.
Right, the stable foundation.
Exactly. But on the other side, you have the severe, undeniable near-term cost and uncertainty imposed by the GTF powder metal crisis. The final conclusion that investors must grapple with is whether RTX's robust diversification and its demonstrated operating efficiency make it the superior long-term investment in the aerospace and defense sector, despite that current premium valuation and despite the massive engine headwind they're battling right now.
And the fact they can absorb it.
The fact that the company can absorb a cash drain of $1.1 billion to $1.3 billion and still maintain the trajectory to hit a baseline FCF of $8.0 billion to $8.5 billion in 2026, well, that speaks volumes about the inherent structural strength that few, if any, other industrial giants possess. It's a testament to the diversification and scale.
Okay, so here's the final provocative thought we want to leave you, the listener, with today. The ultimate question for investors isn't really whether RTX can survive the GTF crisis. It clearly can, financially at least. But perhaps it's whether a company of this immense size, a size where multi-billion-dollar strategic errors can be classified simply as temporary headwinds, is operating on such a systemic scale that it is perhaps too massive to truly fail. Yet maybe also too slow, too complex to achieve truly revolutionary innovation compared to smaller, more specialized, maybe more nimble competitors. That scale absorbs the risk, no doubt. But does it ultimately dull the competitive edge? Something to think about. Risk defined, portfolio protected.